I've often wondered what truly separates the successful investor from the average one. Over the years, through booms and busts, through moments of euphoria and despair, I've come to believe it all begins with one question, the same question Benjamin Graham spent a lifetime answering. How do you know when a stock is really undervalued? Every generation asks it. From the roaring 20s to the digital age, investors have tried to find that secret signal, the hidden formula that reveals value before the rest of the market sees it. Most chase it through predictions, trends, or tips, but Graham approached it differently. He saw investing not as a game of guessing the future, but as a process of measuring the present. You see, Graham wasn't searching for glamour or excitement. He wasn't looking for the next big story. He wanted facts, logic, proof that a stock was worth more than its price suggested. That, to him, was the essence of the undervalued stock. A simple but profound idea, buying dollars for 50 cents. His work forever changed the way we think about investing. Before Graham, Wall Street was a world of speculation, fortunes made and lost on rumors and momentum. After him, investing became a discipline, a craft both on analysis, patience, and reason. In this lesson, I want to take you through Graham's secret formula, the timeless framework he used to find undervalued opportunities in any market, in any era. But this isn't the formula of equations and shortcuts. It's a way of thinking, a philosophy of clarity in a world driven by emotion. We'll uncover how Graham learned these principles in the crucible of the Great Depression, how he defined value when others saw only chaos, and how those same insights still guide disciplined investors today, from Wall Street analysts to everyday individuals building their savings $1 at a time. By the end, you'll understand not only how Graham spotted undervalued stocks, but why his approach still works, because it's grounded in something that never changes, human nature. So let's step back in time, to an era when the market was a battlefield of emotion and uncertainty, the 1920s. It was here, in a world intoxicated by speculation, that Graham's journey toward discovering true value began. And what he saw during those years, and in the painful aftermath that followed, would reshape the entire foundation of investing forever. In the late 1920s, the market was not so different from what we sometimes see today, a place where excitement often replaced reason, and where investors believed prices could only move in one direction, up. Radios were the new technology of the day. Companies were expanding rapidly, and ordinary people were buying stocks on borrowed money, convinced that prosperity had no limits. Graham, already a respected analyst by that time, watched this frenzy unfold with growing unease. He saw the same human impulses that would later echo through history, greed disguised as confidence, and risk mistaken for opportunity. For a while, even he was swept up in it. The market rewarded everyone who played along, and skepticism felt almost foolish. But then came 1929. When the crash hit, it hit hard. Prices fell like stones, fortunes vanished overnight, and the optimism that had filled Wall Street turned into pure panic. Graham himself suffered devastating losses. Yet unlike many who gave up entirely, he treated the disaster as a lesson. He realized that the market's collapse wasn't random, it was the natural consequence of ignoring value. In those dark years that followed as the Great Depression deepened, Graham began to rebuild his approach from the ground up. He studied hundreds of balance sheets and income statements, line by line, looking for answers. What he found was astonishing. Even in a collapsing market, there were companies whose shares traded for less than the cash they held, or less than the value of their assets after all debts were paid.
To most, these beaten-down stocks looked hopeless, but to Graham, they were proof of something deeper, that emotion could drive prices far below the true worth of a business. That's when his philosophy took shape. Value exists independent of price, and the intelligent investor's job is to tell the difference. One famous example from that era was his investment in Northern Pipeline, a company whose stock traded for less than the value of its liquid assets. Graham realized that the market had priced it as if it were doomed, yet the numbers told another story. When the company later distributed its cash holdings to shareholders, Graham's method was vindicated. It wasn't luck, it was logic. That experience taught him a truth that still echoes through every financial crisis. Prices are not always rational. They are a reflection of the crowd's emotions, its hopes, fears, and overreactions. And so, out of the ashes of the 1929 crash, Graham began to define what it truly meant for a stock to be undervalued. But his definition went far beyond just buying cheap. It was about understanding why something was cheap and whether it truly deserved to be undervalued. This led him to the concept that would become the cornerstone of value investing, the difference between market price and intrinsic value. And understanding that difference, as Graham would soon show, was the real secret to spotting undervalued stocks. Graham came to see the market not as a mysterious force, but as a collection of people, emotional, impulsive, and often irrational. To make sense of it all, he developed one of the most enduring metaphors in financial history, Mr. Market. Imagine, he said, that you're in business with a partner named Mr. Market. Every day this partner offers to buy your share of the business or sell you his. But the prices he quotes swing wildly. Some days he's euphoric, willing to pay a fortune for your share. Other days he's depressed, ready to sell it to you for almost nothing. Now, you don't have to engage with him. You can simply ignore his offers until they suit you. Your advantage lies in recognizing that his mood, not your business, determines the price. That simple idea changed everything. It shifted the focus of investing away from predicting the market's mood and toward understanding the value of the underlying business. Graham taught that an investor's role is not to react to Mr. Market, but to patiently wait for his moments of folly, those rare occasions when emotion drives price far below true worth. And that brings us to the essence of undervaluation. To Graham, an undervalued stock wasn't one that merely looked cheap. It was one whose intrinsic value, the actual worth of its assets, earning power, and future potential, exceeded its current market price by a wide margin. Intrinsic value, he explained, could be estimated through facts, earnings records, balance sheets, and dividends, tangible evidence of what a business produced and owned. The market price, on the other hand, was simply an opinion, one that could change dramatically without reason. Graham's genius was in treating stocks not as ticker symbols, but as partial ownership in real businesses. He didn't chase forecasts or trends. He asked simple, profound questions. Is this company earning consistent profits? Does it have a sound financial foundation? Is it selling for less than what it's truly worth? To him, these questions were not just numbers. They were anchors in a storm of speculation. Even today, you can see Graham's wisdom at work. When a company releases a disappointing quarterly results and its stock price plunges 30% overnight, most investors panic. But the Graham-minded investor steps back and asks, has the company's true earning power really declined by 30% overnight? Or is Mr. Market simply having one of his emotional episodes?
That quiet separation between value and price is where opportunity lives. But knowing that undervaluation exists isn't enough. You have to identify it. And to do that, Graham developed a set of practical tests, a structured method to separate genuine bargains from mere market noise. It was, in many ways, his secret formula, not for quick profits, but for intelligent decisions. And that's what we'll explore next, the 5 key tests Graham used to uncover undervalued stocks, the timeless framework that turned chaos into clarity and emotion into opportunity. Graham's secret formula wasn't really a secret at all. It was published plainly in his books, right there for anyone to see. But what made it powerful wasn't its complexity. It was its discipline. He didn't rely on guesswork or predictions about the future. Instead, he relied on evidence, logic, and measurable facts. Through years of study, Graham distilled his approach into a handful of practical tests that could reveal whether a stock was truly undervalued or merely cheap for good reason. These were the same principles he and his students, including a young Warren Buffett, applied to separate real opportunities from traps. Let's walk through Graham's 5 key tests for identifying undervalued stocks. The first test was earnings power versus price. Graham believed that a company's stock price should make sense when compared to its actual earning power. If a company consistently earned, say, $5 per share, and its stock sold for $25, that was a price-to-earnings ratio of 5, implying that you were paying only 5 years' worth of earnings to own the entire business. But if a company earning the same amount sold for $100 per share, you were paying 20 years' worth of earnings, a much riskier bet. He looked for companies where earnings justified far higher prices than the market was currently offering. In other words, he wanted to buy profits on sale. The second test was financial strength. A company could look profitable but still be fragile if it carried too much debt or had weak cash reserves. Graham often sought what he called net-nets, companies that current assets, like cash and receivables, exceeded their total liabilities. It meant that, in theory, even if the business shut down tomorrow, investors could still recover more than the current share price. To him, this wasn't pessimism, it was prudence. It created a built-in cushion of safety against uncertainty. The third test was a stable dividend record. In an era long before buybacks and flashy growth stories, dividends were proof of genuine profitability. Graham valued companies that not only earned money, but shared it consistently with shareholders. A long history of dividends told him that the business was well managed and committed to rewarding their owners. The fourth test was earning stability over at least a decade. Graham was deeply skeptical of sudden success. He saw how quickly good times could turn bad. From the Roaring '20s to the Great Depression, it happened in just a few short years. So he looked for companies that weathered storms and still managed to turn a profit. 10 years of steady earnings told him a company had resilience, not just luck. And the fifth test was valuation, the relationship between price, earnings, and book value. Graham refused to pay high multiples for growth that hadn't yet been proven. Instead, he favored low price-to-earnings and low book-to-back ratios. These numbers revealed how much the market was charging for each dollar of profit or each dollar of real assets. The lower the ratio, the greater the margin between price and value. Individually, these tests were simple. Together, they formed a complete philosophy, one that made speculation unnecessary. Graham's approach turned investing into a process of elimination. Reject the uncertain, the overhyped, and the unproven. And what remains, however dull or overlooked, often holds real value.
But here's what made his insight even more remarkable. He understood that undervalued stocks existed not because of math alone, but because of human behavior. Prices became disconnected from value because investors let their emotions rule their decisions. And that realization led Graham to his next great insight, one that revealed why undervaluation persists and how a calm, rational investor can turn the market's madness into lasting opportunity. Graham often reminded his students that the market is not a perfectly rational machine. It's a living reflection of human emotion. In his words, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. That simple statement reveals one of the deepest truths about investing. In the short term, stock prices move based on popularity, fear, and fashion, the crowd's votes. But over time, the market weighs the true substance of a business, its earnings, assets, and long-term prospects. To illustrate this, Graham created one of his most enduring metaphors, Mr. Market. He described Mr. Market as your business partner, someone who shows up every day offering to buy your share of the business or sell you his. Some days, he's euphoric. He quotes a sky-high price because he's sure the future is bright. Other days, he's depressed. He'll sell at a huge discount because he sees nothing but gloom ahead. Graham's advice was simple. You don't have to follow Mr. Market's moods. In fact, you can profit from them. When he's overly optimistic, you sell to him. When he's despondent, you buy from him. The key is to let his emotions serve you, never to guide you. This idea might sound quaint, but its relevance has only grown stronger. Look at modern examples. During the dot-com bubble of the late 1990s, Mr. Market was ecstatic, offering absurd prices for unprofitable internet stocks. In 2008, during the financial crisis, he was despondent, practically giving away shares of strong, cash-rich businesses. And in 2020, amid the pandemic, he swung from panic to mania within months. Through all these cycles, Graham's principle remained unshaken. Your job as an investor is not to predict the crowd's mood, but to remain rational when others are not. He taught that undervalued stocks appear most clearly when pessimism is widespread. When others see disaster, the value investor sees opportunity. But this requires not just analysis, it requires temperament. Many investors fail not because they lack intelligence, but because they lack emotional control. They chase fads, flee at the first sign of loss, and forget that a share of stock represents ownership in a real business. Graham used to say, "The investor's chief problem, and even his worst enemy, is likely to be himself." To overcome this, he urged investors to adopt what he called a defensive mindset, even when pursuing enterprising opportunities. That meant treating investing as a business, guided by reason, not emotion. This is what made his approach timeless. He didn't just teach people how to find undervalued stocks. He taught them how to think like investors, independent, disciplined, and patient. But this philosophy didn't emerge in a vacuum. It was shaped by one of the most brutal market collapses in history, an event that tested every principle he believed in and ultimately strengthened his resolve to find safety in value. And it was during that crisis that Graham's method truly proved itself. In the late 1920s, the American stock market seemed unstoppable. Prices soared, fortunes were made overnight, and optimism spread like wildfire. The public believed a new era had begun, one where prosperity would never end.
Graham, by then a respected analyst and partner at his own firm, enjoyed success like many others. But even then, he noticed something unsettling. The valuations of many companies no longer reflected their real worth. People weren't buying businesses anymore, they were buying dreams. Stocks with little or no profits were trading at astronomical prices, driven purely by speculation. When the crash of 1929 struck, those dreams evaporated almost overnight. Stocks plunged, businesses collapsed, and even the strongest investors were left reeling. Graham himself suffered devastating losses. His portfolio shrank by nearly 70%. It was a humbling moment, but not a ruinous one. For Graham, it became the turning point of his career. He realized that even the most brilliant analysis could be undone if it ignored the margin of safety, that crucial buffer between price and value that protects investors from the unpredictable. He began to re-examine everything he believed about investing. Instead of focusing on predicting the future, he shifted his attention entirely to what could be known and measured in the present: a company's tangible assets, consistent earnings, and conservative financial structure. He refined his methods, developing the frameworks that would later appear in Security Analysis and The Intelligent Investor. His central insight was this: uncertainty can never be eliminated, but it can be managed if you never pay more than what a business is worth and always leave room for error. To him, the margin of safety was not just a number, it was a philosophy. It was the recognition that human judgment is fallible, markets are emotional, and the future is uncertain. The only defense against those realities was to buy with a wide enough discount that even mistakes wouldn't destroy your capital. Graham often used the example of building a bridge. If an engineer expects the heaviest truck to weigh 10 tons, he doesn't design the bridge to hold 10 tons. He builds it to hold 30. That margin protects against the unexpected. In investing, the same rule applies. He encouraged investors to buy only when they could clearly see that the market price was well below the intrinsic value of the business, typically 2/3 or less. This gave room for error, bad luck, or unforeseen changes. This principle became the cornerstone of his legacy. Even decades later, Warren Buffett would call the margin of safety the single most important concept in investing. But Graham didn't stop there. He knew that understanding value wasn't enough. Investors also needed a reliable way to estimate it. And that's where his next great contribution came in: the search for intrinsic value itself, a method to determine what a company was truly worth beyond the noise of the market. And as we'll see next, this quest led Graham to one of the most practical yet profoundly wise formulas in all of investing. Graham's pursuit of intrinsic value was his way of bringing order to chaos. After living through wild market booms and crushing collapses, he wanted a disciplined framework, something that would allow investors to anchor their decisions in fact rather than emotion. He defined intrinsic value as the true worth of a business based on its assets, earnings, and future prospects, as distinct from its market price. The market might shout one number today and whisper another tomorrow, but intrinsic value, he believed, changed only gradually, guided by business realities, not market sentiment. To estimate it, Graham didn't rely on complex models or speculative forecasts. He used what he called rational approximation. That meant starting with measurable factors like a company's average earnings, dividends, and book value, and applying conservative assumptions. He preferred to underestimate rather than overestimate.
In the later editions of Security Analysis and The Intelligent Investor, Graham introduced a simple formula that became famous. Intrinsic value equals EPS times 8.5 plus 2 times expected growth rate. The 8.5 represented the price-to-earnings ratio for a company with no growth, essentially a fair value baseline. The 2 times growth rate adjusted for reasonable expansion. It wasn't meant to be precise, it was meant to keep investors grounded in reality. This approach gave investors a way to sanity check prices. If a stock's market price was far below its estimated intrinsic value, it might be undervalued. If it was far above, caution was warranted. Let's put this in perspective. During Graham's time, he analyzed companies like Northern Pipeline and National Presto Industries, firms overlooked by the market. Their financial statements revealed strong earnings, solid balance sheets, and minimal debt, yet their stock prices languished at levels far below their liquidation value. To most traders, they were boring. To Graham, they were golden opportunities. In one famous case, Northern Pipeline, a subsidiary of Standard Oil, held substantial cash and bond investments worth far more than its market capitalization. Graham's careful analysis revealed that shareholders could buy the entire company for less than the cash it already owned. It was a textbook example of the market's inefficiency. Fast forward to today, and the same principles apply. We see undervaluation not only in forgotten industrial firms, but sometimes in small-cap tech companies, financials, or even cyclical businesses where fear temporarily clouds judgment. Take the 2020 pandemic crash, for example.
Certain industries, airlines, energy, manufacturing, saw their stock prices plunge 50 to 70%. Yet some of those companies held strong balance sheets and continued to generate cash flow. For disciplined investors using Graham's framework, those dark days offered rare bargains. Of course, Graham never claimed that intrinsic value could be calculated to the penny. He used it as a compass, not a map. The point was not to find the number, but to ensure you were buying far below a reasonable estimate of value. This humility, the willingness to accept uncertainty while still acting rationally, is what set Graham apart. He taught that successful investing isn't about prediction, it's about preparation. And that preparation reached its peak in his concept of the enterprising investor, the active, disciplined individual willing to dig deeper, think independently, and demand a margin of safety in every decision. So how does an enterprising investor apply these lessons today? What steps can they follow to uncover undervalued opportunities in a world that moves faster than ever before? To answer that, we turn to Graham's 5-step blueprint, a timeless method for finding value in any market, in any era. Graham believed that successful investing wasn't reserved for financial elites or market insiders. Anyone, he said, could achieve above-average results if they followed a disciplined framework. He called this investor the enterprising investor, a person willing to think independently, do the work, and demand value in every decision. So what does Graham's 5-step strategy for the enterprising investor look like? Let's walk through it together. Step 1. Focus on facts, not forecasts. Graham's first rule was simple: never invest based on predictions. He saw far too many investors destroy their capital chasing the next big thing. Instead, he urged us to rely on verifiable data, earnings, assets, and long-term performance. During the 1930s, when the economy was in shambles, Graham avoided speculation and focused on cold, hard numbers. While others panicked, he combed through balance sheets and annual reports, finding solid companies trading below their book value. Those factual anchors kept him safe while speculators drowned in emotion. Even today, in an age of artificial intelligence and algorithmic trading, this lesson holds true. Forecasts may grow more sophisticated, but certainty never increases. Facts are timeless. Predictions are fleeting. Step 2. Calculate intrinsic value conservatively. For Graham, estimating a company's worth wasn't about precision, it was about prudence. He believed investors should always use conservative assumptions. If a company's intrinsic value appeared to be $100 per share, the enterprising investor would only consider buying at $70 or less, ensuring a margin of safety. This approach turns uncertainty into opportunity. By buying well below intrinsic value, you give yourself room for mistakes or bad luck. As Graham would say, you don't need to know a man's exact weight to know he's fat. The lesson here is that your analysis doesn't have to be perfect. It just has to be rational, disciplined, and consistently cautious. Step 3. Demand a margin of safety. This is the cornerstone of everything Graham taught. The margin of safety is the gap between a stock's price and its estimated value, your insurance policy against the unknown. Think of it as buying $1 for 60 cents. You might not know what will happen next year, but if you paid well below what the business is truly worth, you've already tilted your odds in your favor. In Graham's own experience, this principle saved him countless times. He found that even when his analysis was imperfect, as it inevitably was, the margin of safety protected his capital and allowed compounding to do its work over time. Step 4. Be emotionally independent. Markets are moved by emotion far more than by logic. Graham saw this firsthand in every boom and bust. His advice? Train yourself to act rationally when others act rashly.
When euphoria dominates, become cautious. When fear reigns, become curious. The enterprising investor must think independently, not to be contrarian for its own sake, but because reason is rare in moments of madness. Graham often reminded students that the market's volatility is not a curse, but a gift. It offers opportunities to buy when others are afraid and to sell when they're greedy. But that requires emotional discipline, the rarest quality of all. Finally, Graham emphasized patience. True value takes time to be recognized. Markets can remain irrational for months or even years, but intrinsic value eventually asserts itself. He encouraged investors to think like business owners, not traders. When you own a stock, you own a piece of a business. You wouldn't sell your bakery because sales dropped for a week, so why sell your shares when the market wavers for a month?
Graham's own career proved the power of patience. His investments often took years to realize their value, but when they did, the results were substantial. Not from sudden gains, but from steady compounding over time. These 5 steps, facts over forecasts, conservative valuation, margin of safety, emotional independence, and patience, formed the essence of Graham's philosophy. They turned speculation into strategy, fear into opportunity, and randomness into order. But perhaps the most surprising lesson is this: Graham never promised excitement. In fact, he said the investor's chief requirement is patience, not brilliance. His system wasn't designed to thrill, it was designed to endure. And that endurance is precisely why, nearly a century later, his lessons remain as powerful as ever. Because while markets have changed beyond recognition, from ticker tape to digital screens, human nature hasn't changed at all. And that's where Graham's wisdom finds its eternal home, not in the numbers, but in our behavior. But before we close, there's one last insight from Graham that completes the picture, a reflection that explains why his philosophy will always outlast the fashions of the market. Segment 7: The Timeless Legacy and Key Takeaway. As I look back on Graham's philosophy, I realized it wasn't merely about stocks or markets, it was about human nature, our impulses, fears, and hopes. He saw investing as a mirror that reveals who we are when faced with uncertainty. And through that mirror, he gave us a way not just to make money, but to think clearly in a world ruled by noise. Graham once said, "The essence of investment management is the management of risks, not the management of returns." That single sentence captures the wisdom of a lifetime. He understood that wealth isn't built by chasing returns, it's built by avoiding ruin. By protecting your downside, you allow the upside to take care of itself. His ideas survived not because they promised quick gains, but because they rested on principles that never age: prudence, discipline, and reason. These qualities were just as vital in the chaotic 1930s as they are in the algorithmic-driven markets of today. Consider how often the same patterns repeat: speculative booms, crushing busts, the lure of new technology, and the belief that this time is different. Yet each time, Graham's principles quietly wait in the background, ready to guide those who choose reason over emotion. The rise of index funds, the value growth debate, even Warren Buffett's legendary success all trace their roots to Graham's foundational ideas. His insistence on a margin of safety, his view of the market as a manic partner, and his relentless search for intrinsic value have shaped generations of thoughtful investors. But his legacy extends even further. Graham's greatest gift was teaching that investing is not about beating others, it's about mastering yourself. The true enterprising investor doesn't compete with the market,
He collaborates with it, buying when value appears and waiting patiently while others chase illusions. In a sense, Graham taught us how to remain calm in a world built on impatience. He showed that real wealth grows slowly, through knowledge, restraint, and conviction. So when we ask, how do we spot undervalued stocks today? The answer isn't just in ratios or formulas. It's in mindset. It's in the willingness to look beyond fashion and find truth in fundamentals. It's in refusing to let Mr. Market dictate our emotions. That's the enduring power of Graham's secret formula. Not a trick or shortcut, but a philosophy rooted in realism and humility. If you apply his lessons today, study the facts, think independently, demand a margin of safety, and stay patient, your capital won't just work hard, it will work wisely. And perhaps more importantly, you'll discover that investing, at its best, is an act of self-mastery, the quiet pursuit of understanding in a world addicted to excitement. That was Benjamin Graham's true genius, transforming investing from a game of chance into a discipline of thought. His words still echo through time, reminding us that value doesn't disappear, it only waits for those patient enough to find it. So, as you watch the markets rise and fall, remember Graham's enduring lesson. Price is what you pay. Value is what you get. And when you invest with that wisdom, calmly, thoughtfully, and with a margin of safety, your capital will not only survive the storms of the market, it will grow stronger through them. That's the legacy of Benjamin Graham and the timeless art of finding value wherever it hides.